Hey everybody, Mike here. I'm going to talk about Weibo today. Now, I don't think a lot of people have heard of Weibo in the Western world, Western investment world here. Um, but in China, people have heard of it. Everybody knows Weibo. It's the second biggest social media app in the country behind WeChat, and is essentially known as the Twitter of China. So Weibo literally means microblog. I opened a position a few months ago, I believe in December at 29, ticker symbol WB, and recently I bought another chunk at $22 essentially. I bought it in Hong Kong. I believe it was 172 Hong Kong dollars, but I added it 22 roughly, and I think that my overall average cost is about 26 if we're looking at the US listing. So this is, for me, this is not a company that I know, backwards and forwards and upside down. This is, I'm basically doing this, I'm buying this based on numbers and a lot of the really great metrics that this company has, which I'll get to later in the video. But this is like a 30,000 foot view of this company. So if you want really in-depth information, this is maybe not the right video for you, but I'll talk about my investment thesis here. Generally, I have two buckets of companies that I own. One is that I companies that I know really well, and I know everything about them, and I'm really confident that I understand the business, and I might be willing to buy them at a little bit higher price because I understand them a lot better, and I can see what the future looks like quite well. And so those ones I might pay a little bit higher price for. I don't always, but some of them I do. Like for instance, Alibaba, I started buying at a higher level because I had more confidence in the company. And then I have another bucket of stocks that they're just so cheap that it affords me a margin of safety that I need because I don't know this company that well. Like I've been following these guys for 4 years, but I can't say that I'm really super confident that I could explain how they do what they do. I know what they do, but I don't know if I know how they do it. So this one is definitely in the second bucket. It's super cheap. It has a big margin of safety as far as I can tell, and it's finally fallen into my buy zone here where I've got a margin of safety. Okay, so the company actually reports earnings on the 1st of June, which I depends when I get this out, but I wanted to buy before earnings, and this is maybe silly of me, but I've noticed a pattern with China. I believe that the sentiment is changing in China. Now, if you look at US stocks, what's happening is every time they report, if they report good earnings, it's kind of the stock's flat. And if they report bad earnings, the stock gets absolutely annihilated. I mean, we saw Snap and some other ones recently last week that just got decimated. So that's typical bear market behavior. Good news is neutral and bad news is terrible. Whereas I've noticed a difference in China recently, whereas when they're reporting, like Tencent, I didn't think the results were very good at all. I thought they were quite bad, and the stock ended up mostly flat. And then I read Alibaba's, which I didn't think were that great either. They were okay, but the stock was way up. So I think that and there's a bunch of other examples of that in China. And I think with all the government support, the verbal support of the markets and the economy, and the anticipation that they're going to start turning on the macro taps, I think the sentiment is turning in China. And I wanted to get in before the earnings because I think there's a decent possibility there's going to be a jump here when Weibo reports. Okay, so 3 parts of this video. I'll just start by talking about Weibo and comparing it to Twitter a little bit to start, and then I will go into the financials and the numbers, which is the meat of the reason I'm buying this, and then I'll talk about risks after that. And I think there's one major risk here that you should really pay attention to if you're interested in this stock, and that's outside of the normal noise around China, the delisting, Taiwan, et cetera, et cetera. It's not that stuff. It's company specific. So I'll go into that one after. All right. In terms of the comparison to Twitter, actually, Weibo is surprisingly, it's actually a bigger company. They have, I think, 573 million users as of the last quarter, which is far bigger than Twitter, as far as I can tell. They don't report users in the same way, but based on this graphic here, I think that there's a fairly big gap there. Twitter publishes their daily active users, which is in the 200 million range. So I couldn't find confirmation on how many actual total users they had. But I guess whatever the number is, Elon Musk would argue that it's 25% lower, so he should get a discount. Okay, what else? It's basically the same concept here. It's a microblog site where you have a character limit in terms of your post. And the main feature is you can follow whoever you want, just like Twitter, right? So you can create your own little ecosystem of your interests and just get news feeds on all the things you're interested in. I do think that these companies they both have fairly strong moats. They have the network effect where just sort of the everybody's there, so everybody goes there effect. And it's kind of hard to drive a wedge into that because you need a whole pile of people to move to a new platform all at once. We've seen that Twitter's been extremely resilient in the face of competition, and I think that Weibo is showing the same resilience. And they have a monster out there called WeChat, and at this point, WeChat hasn't been able to put a dent in them. And just incidentally, with WeChat, I was saying that Weibo is the number 2 social media platform. WeChat is number 1. But WeChat is a closed community. So you invite people you want. You talk to your friends and stuff like that. Similar to, Facebook, right? Or WhatsApp maybe. And Weibo is like Twitter, where it's like open. You can just follow whoever you want. So the celebrities tend to be the biggest accounts on Weibo. All right, in terms of financials, I love this stuff with this company. Like I'm a numbers guy, and man, a lot of this stuff looks really good to me. So if you see revenue here, revenue is up to 2.2 billion. They had a bit of a stall in the 2019-2020 period, but other than that, it's a fairly consistent growth rate, or it's fairly consistent growth in terms of revenue over the years. Current market cap's 5.4 billion, so that puts the price to sales at 2.4. That's not fantastic, but lower down we're going to get some better numbers. They have 3.5 billion in cash, and the net cash after the debt's about $1 billion. So tangible equity is 3.3 billion, which puts the price to book at 1.6. Now, if we look at the adjusted net income, which is 718 million, that is an enormous profit margin. Their margin is almost 32%. So if you were wondering, do they have a moat? Is this moat real? Well, usually you can tell when companies have a big profit margin, it indicates a very strong moat. Their operating margin is almost 40%. Okay, so this is a cash cow. It's a growing cash cow. They churn out money consistently every year. And if we look at the EPS, the GAAP number is 1.87 and the non-GAAP is over $3, so 308. Now, I go with the non-GAAP number because one of the big effects on earnings in these types of companies is that they have to report the change in their value of the companies they hold. So if they own public companies, as the stock price goes up and down of these companies, they have to report that movement on their income statement. So I don't think that has anything to do with the cash generating ability of the actual business. So I have no interest in putting that on the income statement. So if we remove that, and also if we remove, they take out the expense due to shares issued to employees. And now you could argue that should be included in there because that's an expense. Otherwise, they'd have to have some cash payroll expenses. I'm just going to make it easy for myself and say I'm going to take all of that out like they're doing on their non-GAAP numbers and have it at 308. So if we look at that and we remove the cash from the market cap, the net cash from the market cap, you get a price earnings ratio of just over 6, which is extremely small. Now, it's possible that the growth rate slows down here. The analysts say that they believe that the growth rate is going to slow down to about 6% going forward. I don't know how much the analysts actually know. They usually miss the mark, or else the company just guides lower and then they beat that. But the analysts are estimating 6% growth rate going forward. So if there's one number that doesn't look great, that's probably it. But if you're getting a 6% growth rate on a 6 times PE, that's still a PEG of 1, and a really good deal as far as I can tell for a company with a strong moat that has big margins and also big return on their capital. So return on equity is over 20%, it's almost 22, and return on invested capital is 21%. I'm not 100% sure if they can reinvest like they have actual projects to invest at those rates, but let's just say that their earnings or the return on capital is very high. And just quickly, one other thing I like about this company is that we all know that the trends in online advertising are mostly up, and I believe that we are still in the early stages of moving to online advertising. I think if we look forward 10 years, the rates and the number of businesses that do advertise online, both of those are going to be much higher than they are today. I don't think we're anywhere near the peak, as a lot of companies still advertise on traditional ad platforms like AM, FM radio and print and things like that. So there's still quite a lot of tailwinds behind companies like this, I believe. Okay, and then turning to risks, I'm just going to talk about one main risk here. I mean, you can go and do your own research on delisting risks, or things like what you think the chances are of China invading Taiwan are. I talked about that in one of my Alibaba videos. So if you're interested in my thoughts, please look at that. But just quickly on delisting, if you are worried that it's possible that they're going to delist, I think maybe it makes sense just to buy in Hong Kong, which is what I've done. Save myself the headache just in case they do delist the US shares and I have to move over. But essentially, you can just move your shares over if they delist anyway. So that's not really a risk in my mind. Now, for the big risk here is privatization. So one of the big owners, his name is Charles Chow, and he was reported to have been trying to take the company private back in July last year at $90 to $100. Now he refuted this report. Now Charles Chow does have a history of doing this. In fact, he took the parent company of Weibo private previously, and he did that just at an 18% premium to the market price at this time. So if you were holding Sina shares, you got screwed pretty badly. So that is definitely one of the risks here, and probably the main one for me, that he sees these low prices and he just lowballs, what's 18% over 22. So that's maybe what, 2.4. That could be around $26. So if he did that right now, then I might just get my money back. And the lower the shares go, the higher the risk of this occurring. So, and also if the reports were true that he was interested in taking it private at $90 to $100, well, you got to believe that he's probably licking his chops at the current price. One final thing to keep in mind with this company is they, because they're so public and they have so many users and the user posts are public, the CCP has a close eye on them. Now, Weibo's been shut down for a few days here and there because of posts that have happened on their platform. That's mostly in the past. It seems like what Weibo does now is they are actively policing their accounts pretty closely and removing accounts that don't comply with CCP sort of narrative. So I don't know if this is a risk or not, but it seems to me Weibo is fairly compliant with the CCP, and they're very aware that that's part of the game, is to basically control their content on their platform. Okay, so just to finish up here, one of the reasons I bought it, I mentioned this at the beginning, was because I believe that there's sort of a sentiment play here. Everyone's heard this saying, buy when there's blood in the streets. Well, there's blood in the streets in China in terms of the investing world. These stocks have been beaten down for over a year now, and all the headlines have been negative over on this side of the ocean. So this is a blood in the streets situation. Now, if you've been paying attention to People's Bank of China or the CCP or some of the other regulatory bodies, they're talking very supportive right now. They're talking about supporting markets. They're talking about supporting the economy. They're talking about increasing liquidity in the markets. And as we know from the last 15 years of the stock market in basically any country, is that these central banks are one of the key factors in terms of what direction the stocks go. Now, China actually has the ability to support their markets here because their inflation rate's quite low, in a way that the US or Canada or Europe don't have the ability to, because they're fighting in two different directions. Inflation in one direction, and if they have to fight the economy in the other direction, those are not the same fights. You actually have to do the exact opposite to fight one of them. So they have to pick their poison now, whereas China doesn't actually have to do that. They don't have that problem. So I believe that this is a sentiment shift, and this is a macro shift to a time when China becomes a lot more bullish. I like Jim Rogers. I like some of his quotes, and at some point he bought Japanese ETFs because he found out that the Bank of Japan was going to start buying these stock ETFs, and his line was, "Well, they've got more money than I do, so I'm going to do what they're doing." And I think that's kind of the situation here. Once you see the central bank get on the train of if they want markets to go that way, I think markets are probably going to go that way. It would be silly to fight in the other direction. So with that, I will leave you there. If you have any comments about things that I've missed, any risks, I would love to hear them in the comments. And if you disagree with anything, please let me know. Thanks. Have a great day, guys.